Every once in a while, an investor thinks they've found the next big thing, something that's going to earn them incredulous returns year upon year upon year. Right now, you're in that situation. Havasay is seeing the valuation so strong for their company. You have the opportunity, Mr. Willoughby, to get out now, take a whole bunch of money, and find a way to reinvest it. Our recommendation is going to walk you through why it is the best decision to sell the company now at the existing valuation, and why you have the opportunity to return a lot more in the future with this decision. First of all, you will see selling the firm for $10 million. You'll also notice that with the 20% potential that we've added on, if the firm earns $3.5 million in net income in year number 5, that also means that you're going to return, the total valuation is going to be worth approximately $14.5 million when calculating the value of long-term debt for the enterprise value. In addition to this implementation of the installation line, we've seen that there is the potential to take beyond the cloud computing software. We now have an opportunity to hit new businesses, small businesses, who want an opportunity to use their own remote servers, something a little more technical, hitting a slightly larger market, and being able to expand your market share in Canadian and American markets. On top of this, you'll see that we want to phase yourself out as CEO. We understand that you have the opportunity to take the 20% ownership stake, and we want you to do so. By the end of year 5, we want you to look at the next project. And we ask, what is the next project? The next project is CRM, and a new CRM system that's going to hit the changing demographics of the United States business environment. Now looking at our overview today on the next slide, you'll see that we have received an offer for the firm, and this offer is a fantastic offer. We valued it at $14.5 million. And as I explained, that's a $10 million personal cash stake. Great investment for you, something you've, in a short period of time, you've earned a large return in this investment right here. You also notice that with that 20%, and with what we're about to show you, there's the potential for massive gains. With that, I'll pass to Jimmy to look forward to the analysis.
So you can see an overview of our valuation summary. So we looked at discounted cash flow with the installations project that you mentioned in your report to us that you're currently not utilizing, but could utilize moving forward. The comparable with Marcelo, also the comparable without Marcelo. 14.5 is where we see the valuation coming in the takeover bid. And as you can see, where we would value your company normally using our methodologies, they are all below that value. So 14.5 is a very attractive offer that's been put on the table. Let's look a little bit at the situation that we have in front of us. Your company has many strengths. Number one, you offer a wide range of services in efficiency management. That's what you're doing. You're making companies more efficient by letting them know what they have and what they need without them having to do that work themselves. You have a very easy system to deploy, and small companies, small organizations, so this is targeted at, need that easy deploy system with a small file size of operating it and the on-hands experience that comes with working with a small organization such as yours. It's an inexpensive product that can help them make money in the long run. However, as we go through this, every company unfortunately has weaknesses. With your organization, a very highly levered debt, and in this case, it's mostly bootstrapping debt. So Mr. Willoughby, that's on you. As the company moves forward, you have had an option to further mortgage some of your assets to move the company forward, but that's putting you even more in the corner without a way out. So you're very highly leveraged with bootstrapping debt. Further, your product is offered online only currently. And while that may be interesting to some companies, there are other companies who are not undertaking that. And what that means is there's an opportunity for you to grow there. However, it's also a current threat because there's an opportunity for a competitor to offer that same service. Speaking about opportunities, as I said, there's the opportunity to grow that installation service. You already have a model for it. You have the big stuff in place. Now you just need consultants and people who can go out, teach people how to use it, teach people how to run it in their own servers, and utilize in their business through that means. Further, that'll take pressure off of your servers. That's something you won't have to deal with in-house anymore. If you have the opportunity and a great idea to start a customer relations management system in the same model as this, not something that would cannibalize this product, but something that would run in parallel. Lastly, with opportunity, we're seeing more trend toward efficiency, growing through efficiency, and efficiency fuels productivity. When you look at efficiency, what does it do? It frees up your assets, it frees up your cash, and removes waste. It eliminates opportunity costs so that you can take those opportunity costs, the energy that would go into that, and put that energy into becoming more efficient and running a better organization. Regrets, we see a bear market. So far, you've made it through the bear market. To this point, however, as companies continue to go, as their bottom lines get tighter, this is something that they may not be able to afford. They may go back into doing this manually, tracking their systems manually, and moving through those needs. There's an absolute potential for increased competition, low barriers to entry. What do you need to utilize one of these systems? Some programmers, an understanding of the system, how it works. Where you really excel in this is your IT background. You've heard all this coming from companies, coming from your own internal customers in the past, saying, we want a system that does this, our system does not do this, and we would like it to, and this is how, if our system worked in this way, we can better use our time to work with customers to create a better product and to move forward. I'll now pass it back down to the comparables analysis.
So when we saw this valuation, we thought, is this too good to be true? So first of all, we looked at the discounted cash flow valuation, but then we took it to the comparable stage. And this is really where we broke down what we've seen. Now you'll see that on the left-hand side, when we calculated your enterprise value multiple, you're noticing that the industry average comes to approximately 6.48 times. Now with that valuation at the average level, that's bringing in Morelco. Now Morelco is a much larger firm. We saw their sale price going for over $55 million. We think they're not necessarily the most appropriate target because of that size. So we edited the comparables group a little bit when we moved it over. You can see in the yellow we subtracted. That's also changed our average up to a 7.75 times multiple, and that's brought the valuation at a base case, the very base, to almost $10 million. Beyond that, when we look at the best case scenario, we could be looking upwards of $13 million. You have to recognize that our best case is only at the 75th percentile. There is the percentage to go to a higher percentile because of the unique nature of the business, because of how you can access clients over the internet, and how easy it is to spread your product compared to someone else who's 100% installation based. So as we move on, this is our discounted cash flow analysis. You'll see that the target debt to value ratio is 0.6. Looking at the other factors, we have a risk premium of 13%, the cost of equity at 17%, the cost of debt at 7.5%, and a weighted average cost of capital at 9.9%. Now I'd like to draw your attention to the risk premium. We saw that Leaside Capital gave you a 33% risk premium. We think this is unrealistic. This is what's driving the valuation that they found. And 33% valuation for an industry average that is around 5% isn't very realistic. We think that the company's not in an extreme bear market where it's going to drive you to potential failure. And 33% risk premium is usually seen for a startup venture in the tech sector, possibly in the late 90s, that had a high potential of failure. You don't have that potential for failure, but you have the potential for growth. You'll see that our discounted cash flow valuation has balanced out some of these factors. We've done a very conservative estimate of revenue growth compared to what they had to give you. And we found our valuation with installations sits around $10 million and without at around $8 million. I'd also like to draw your attention to the fact that with the growth rate that was proposed in the case, your cash flows per year would have to range around 90% under the existing valuation because of the market premium applied. That means that they think your company is going to blow up. And the great thing about that is, in this situation, valuation shows even with a conservative estimate, you're making money. But in the case that the company does take off, you're earning that 20% back, you're earning a high value of profits, and you've walked away with $10 million. It's a win-win all around. So passing this to Matt, he's going to look a little bit at our alternatives.
Awesome. So after going through our alternatives, we came up with 3 simple terms. First is status quo. Right now, bootstrap financing, you got some assets on the line that you could go out and remortgage, but ultimately, do you really want to do that? You have some capital requirements right now that you need to fund, and so that's an issue with going forward with status quo. And there's no real potential for future growth. Do you want to be a CEO or do you want to be an entrepreneur? Well, if you take our recommendation, you get to go back and be an entrepreneur. But if you want to be a CEO still in an intermediate or full-size firm, even with this recommendation, you still can stay on with that firm 5-6 years, depending on how much you want. But this recommendation allows you to go start up your CRM business and be an entrepreneur. The second alternative we came up with was shop around for a new buyer. It's very risky at the end of the day. We have a really good valuation right now. they're valuating you at $14.5 million when you include the debt value. It's extremely overvalued, at least in our opinion, but ultimately at the end of the day, we think it makes sense. And then finally, our other alternative is to sell the company for the existing valuation of Leaside. They have a super high valuation, a strong strategic partner in Leaside, and lots of opportunities within their management, in their private equity firm, that are going to be able to use their networks so that you can sell your products better. And finally, like I said before, with our recommendation, which is the bottom alternative at the end of the day, you have the potential for future mobility to move back and become an entrepreneur. So our decision criteria was based on 4 different things. Your future lifestyle desires, like I said, like I've been saying, do you want to be a CEO or do you want to be an entrepreneur? Your future wealth, do you want to go to mortgage your house again and look at mortgaging different types of assets and living a lifestyle, or do you want $10 million right now? Third one is personal financial information, especially going forward with a potential new venture in CRM. This allows you to do so. And fourth is necessary financing. You need new money. You're very over-leveraged right now. Your balance sheet has negative retained earnings, and at the end of the day, you have to find some more money to do that marketing venture and to launch your new installation services system. So that decision criteria led us to our recommendation, which of course is to accept it. So what's next? The implementation is fairly simple. First, we're going to sell the company for the accepted valuation. We want to ensure that Leaside's able to, of course, obtain the necessary capital required. It's not, necessarily banks that's going to grant you this loan. We haven't seen their financial statements, so that's the first thing that you got to make sure. Second part, we want to move forward with negotiations with Leaside. Sit down with them, talk to the lawyers, talk with the accountants. An acquisition is not an easy thing. It doesn't happen just overnight. You're going to have a lot of different important parts to talk with them about, non-compete clauses, stuff like that. That's all stuff that's going to happen later on in the deal. But the valuation itself looks really good, so we want to go forward with it. Second of all, we believe that you should begin your phase out as a CEO over the next 3 to 5 years. Of course, that's your option to do, but we feel that you have a strong opportunity in this CRM venture, and we think that you should take it out. We want to use the capital from this new sale, and we want to upgrade the current systems and marketing within the other company. And we want to implement the installation side, very, very soon, within the next 0 to 6 months. And of course, while you're doing this, you want to constantly monitor the CRM opportunity. Finally, at the end of the day, you want to begin the CRM. It's a similar business model, but we think it's far enough away from your current business that it's not going to upset Leaside. You're not going to be competing directly with them, so it probably won't, and we generally don't believe it should compete with any kind of non-compete clause. But that's why that first point of the implementation, but meeting with the lawyers to make sure that your CRM opportunity is able to go through even with a non-compete clause. So that's essential. So the risk mitigation, I'll pass off to Adam to
So we'll walk a little bit more into this. And you saw that when we presented at the start, we identified some of the risks that you're facing right now. These are the risks that could come with the recommendation and implementation of our plan. Now, first off, a potential company doesn't hit your earnings target to earn that 20% of the company. We recognize that this is very real because with your conservative forecast, you're not reaching that $3.5 million. At the same time, you'll see that there is still a high cash valuation. The $10 million you're receiving upfront in cash, plus the burden of debt they're taking off of you, makes this a very attractive valuation. Secondly, Leaside Capital has such great free cash flows growing at the 90% value. We believe there has to be some merit in this. They have internal synergies with some of the existing clients and businesses they have under their venture capitalist wing. We think that they're going to implement your system into some of those other wings and really find a way to make their processes more efficient and also sell your product to a larger number of users. At the same time, there's exponential growth. This is always a risk, because that risk means that you would not be getting the same valuation. But we have to recognize that you still have a 20% stake if this happens. No matter what, that valuation you lost, you're earning 20% of that back. Let's say your valuation now is $10 million. In a few years, it doubles to, in a 10-year period, it jumps to 50. You're earning another 20% of that 50. You're in a fantastic position with how the company is positioned. Also, the opportunity for CRM is not profitable. We recognize this is a second step to our recommendation. And we have to recognize that you are still earning profits by being CEO existingly. You still own that ownership stake. You step down as CEO, you can make a move to the board, so you still get to be the entrepreneur you want to be. And there are other service opportunities out there. You're very knowledgeable in this industry. You're very knowledgeable as a whole about the technology sector. And it's a great opportunity to expand the current projects you have and move on to future projects. So looking today at our summary, before I look at our financials, what did we suggest? We said to sell the firm for a suggested valuation of $10 million, earning that extra on top of it and bringing in the extra installation line. What this installation line will allow you to do is, as I said earlier, access a new database of customers, a wider database and one that's diverse through Canada and the United States. A small investment banking like our firm like ourselves, for example, needs a small database to enter our information, and this is the perfect type of opportunity on a remote server. In addition to that, phasing yourself out as CEO. This is an extremely important part if you want to maintain that entrepreneurial spirit that you have deep burning inside you. You've seen that the reason you got out of the business was to try something for yourself. You took a lot of risks to get where you are. You bootstrapped, which shows you have an extreme passion for the industry, extreme passion for your company, something many people aren't willing to take to such a level that you have. And the fact that you're looking at refinancing your home and refinancing your other properties to get a new mortgage to help this company out, even in the position it's at just for future growth, shows that you care about the company. You want future growth, you want future profits, and you need necessary capital. This valuation gives you the capital. This valuation gives you the potential for growth. This value is risk averse, it gets you out now, it gives you lots, it's based on a conservative valuation, and in the future, there is the potential for a lot more money. Also, pursuing the CRM. And I wish we could talk a little bit more about the details of this recommendation, because it is such a fantastic plan, but as we run out of time, I would like to turn it over to Matt to just look a little bit more at discounted cash flow valuation for your understanding.
So just to go into some quick specifics, I know we're running out of time here, but this is our DCF valuation, which was the metric we thought was the best metric to use for valuation. Basically, we did it two different ways. If you look at line 3, free cash was confirmed with the installations, and the second one was without installations. This gave us, at the end of the day, enterprise our valuations, which were very, very close to the valuation that you're getting in terms of cash. But keep in mind, this firm also has $1.4 billion in debt. That debt is significant because what it should do is it should reduce the amount of money that you're getting from your firm. But the $10 million at the end of the day, you're still getting in cash up front, plus you're getting 20% of the stock at the end of the day. That alone brings their valuation up to $12.5 million, about $3.5 million more than our valuation based on these DCF financials. That's a 33% increase, a 33% premium. When you tack debt onto that, at the end of the day, that is almost a 60% increase on that, or 50% increase on valuation. This valuation is too good to refuse. You have some opportunities here to move forward, be a successful entrepreneur in a new business, and be a part of a growing industry in the private equity firm, Leaside Capital. So our recommendation, just to conclude, is to accept the offer. At the end of the day, we feel it's the best offer. So with that, we'll open the floor up to any questions.
You made the point that you saw Leaside as a strong strategic partner. They have no expertise in the IT area or this industry. Why do you say that?
We see them as a strong strategic partner because if you look at where their other partnerships is, other holdings that they have, it's a transportation company, it's an online pharmaceutical company, it's with a food distribution company. The head of that organization has offices in every one of their, there's a private office in every one of those headquarters. Their customers and their operations are based around efficiencies, around shipping, around knowing what you have and knowing what you need. So they'll be able to branch out through those organizations and leverage your product. Further, they'll be able to branch out to those organizations' customers who are relying on shipping, food arrivals, and pharmaceutical orders in order to spread your product through channels that already exist in their network.
I think if I could just quickly add to that, if you look at their valuation, keep in mind they evaluated you with a 33% risk premium. To get the valuation that they did, they have your profits growing at 90% a year for the next 5 years. That's profits, not revenue. So clearly they have some ideas about the synergies and the opportunities, and so we feel that they have the experience in order to take this from point A to point B.
You're basing such a large part of the value on the 20% stake in 5 years. What's the risk? We're taking the sales from $4 million to $40 million. We're taking the revenue from $600,000 to $3.5 million. And those are all minimums, of course, right? And there's some things that aren't defined in their proposal as what they're drawing and so on. Let's just exclude those. What's the probability of being able to do that? It's amounts to about a third of what you think the value is.
Well, that's the great thing. I mean, when we look at that, the third is there, but this is a $10 million. With how heavily levered you are right now and what it's going to take for the extra financing, that $10 million has to be weighted heavily. The other 20% is a greater upturn in the long run, but it's not the guaranteed 20%. Now, while we've weighed that into our valuation, adding that 30% like Matt talked about, it isn't the most important part of the $10 million. And some of the risks that come with that clearly are that you're not going to be able to reach that. It is a great growth, like you said, $4 million to $40 million. But we do believe that with the valuation they've given it, and with the synergies we identified with transportation and fruit companies, that there clearly is upside potential that they've identified. You wouldn't expect such unreal growth in that forecast. That $3.5 million you're also getting back on net income is actually quite a bit below the 90% they forecast. We worked it out closer to the 30 to 40% growth range. So you're in a very strong position. We see the risk is not too heavily because of the valuation they've given you and because of the multiples approach that we took to show what other companies are earning.
I can just add to that real quick. At the end of the day, $10 million is cash in your pocket no matter what. That's excluding the 20%. If you look at these valuation metrics that we use, we believe you're worth in and around the $9 million mark. You're still getting a premium for that $10 million, plus then you're getting 20% at the end of the day. So even if you don't, even if they don't make that sales, which we don't think that will happen, like I said, they're evaluating your profits growing at 90% a year over the next 5 years. You still have $10 million in your pocket, which is more than this firm's worth currently.
Where did you come up with the assumption or conclusion that the $10 million was they would also assume the debt of $1.5 million? At least I believe that's what you indicated when you were talking about the slide on that.
Yes, it was. When we looked at it, we calculated it from an enterprise value perspective. So we know that as a buyer, you're getting the market cap back, and it's under the firm's valuation that they have to assume the value of the debt without paying for it. So, for example, when a company is going to acquire someone, they're going to take the market capitalization, add on that extra long-term debt that they financed in and subtract the cash. We made that calculation to get our multiples, and that's just a burden they have to take on the debt. That goes on their balance sheet. So it's not something they have to pay us for. It's just something they have to weigh intrinsically when they're making the valuation themselves. That's why we pointed out the extra value of that debt on the debt.
Any further questions?
I have one more. You are excluding Morelco because it had a 1.something 39 EBITDA factor, right? I think it's 12 in the material, isn't it?
We had it at, I believe it was 55, and then the price they paid, and then price was what the total value of the takeover was. I honestly wouldn't be able to say offhand. That's the number we got running in. Yeah, at the end of the day, we took it out either way. We wouldn't have included it if it was a higher multiple, because it's not accurate to use a firm that is in the range of 10 to 12 times larger. In any case, when you're using
That's it for
comparable
questions.
transactions.
Answer, please.